Hi, my name is Liz Thompson, and this is a video for IME 315, Financial Decision Making for Engineers at Cal Poly San Luis Obispo. This particular video is on cash flow statements. If we look at the 5 items that are covered in this particular class, this video is related to reporting and managing profits. And particularly, we're going to be looking at the 3 types of reports that come out of accounting, and this video looks at the cash flow statement or the sources and uses of funds statement. So to think through the idea of a cash flow statement, I've developed a sort of equality or a balance that has to happen. And you can think about this like your checking account, where you have an initial balance in your checking account, and then you have cash coming in during a particular time period. You also have cash going out during the time period. And then the net of all of that is the ending cash balance. So if we just look at this with some numbers to try to get a little bit more specific, let's say we have an initial balance of $2,000. Cash in during the period is $5,000, and this is cash in as an individual checking account, or is also cash in if you're a company where you're making revenue during the time period. And then you have cash out, or expenses that you would be incurring, or ways that you're going to be spending your money. And then you have the ending balance. So your beginning balance was $2,000, you added $5,000, you subtracted $6,000, and that meant your ending balance was $1,000. So if we look at the parallel in a cash flow statement, there's 3 parts of a cash flow statement. The first is cash from operations, which is the inflow into the company from the profit-making portion of the business. There's cash out, and there's 2 sections of that. One is investing, so the way in which you're putting that money you got from the company back into the company. And then the others is financing, or the way that you're paying off your owners, whether it's liability owners or equity owners. So are the ways that you're taking some of the cash that you're making and returning it to the owners. And then the difference between the beginning cash and the ending cash is the change in cash. And that's another aspect of the statement, the cash flow statement. So this is an example of the cash flow statement. You can see there's 3 sections. The first is the cash from operations, which is that inflow portion. And then the investing activities and the financing activities is usually thought of as how you're using that money. And then the change in cash is the difference between the beginning balance and the ending balance. So we're going to go through each of these line by line. The first thing I want to point out, though, is that in accounting is that when you have a parentheses around a number, it's actually indicates a negative number. So you can see there where it says capital expenditures is $2,000 with parentheses around it. That means it's negative $2,000. So the first line item in a cash flow statement is the exact same income that is in the income statement. So this is the way that the 3 statements are connected. We start with the net income from the net income statement, and then we add to that the items that are what's called non-cash items. So items that are write-offs for tax purposes, but not affecting cash. And we're adding that back in because the net income included that as a deduction, and we want to get rid of that. So in this case, the $3,000 plus the non-cash means that actual cash we have is $4,000. So that's the sum of those 2 items. And then we move to the investing activity. So we have $4,000. What are we going to do with that money? And one thing we can do with that money is invest in our assets. Buy more machinery, buy more land, buy more buildings, invest in patents, whatever it is where we're going to add to the assets of our company. And that would be a negative to that cash flow. So we take that $4,000 and we're going to spend some of it on assets. Now, the other thing we can do is we can actually sell assets, which is an opposite aspect of investing. So let's say we sold a particular computer or a patent or something. We're going to get money into our company for selling this asset. So the net of it is the net for investing activities is the amount we spent to increase the assets, less any kind of income we had that where we were divesting the assets or selling assets. So in this case, we had a net of $1,500 negative. The next section looks at financing activities, and there's two aspects of financing activities. There's loans or liabilities that we changed, or there's equity that we changed. So this looks at the owner's portion. If the owner's liabilities, it's called loans, and if it's an equity portion or the owners of the company, it would be showing up in equity. So in this case, we have we can get a new loan, which we did in this case, where we have a $2,000 income into our company. We could also pay off loans. So we might have a negative value in here if we paid off loans, and that would be a negative number in here. In the equity portion, we can return money to the shareholders in two ways. One is we can buy back shares or we can pay dividends. That would be a negative in this aspect. So in this case, we have a negative $1,000 where we returned money to the owners. We can also issue new equity, so we can sell more shares of our stock, and that would be an income into the cash flow. So in this case, we have a net of $1,000, which is the loans, the new loans, less the amount we paid back to shareholders. So if we look at the $4,000 from operations, and we took $1,500 of that, and we gave it to we spent on capital expenditures, and then we also got a $1,000 increase into from financing activities. So the net change in assets, net change in cash is $3,500. So we increased our cash balance by $3,500. So that's a simple look at the cash flow statement, and again, it falls in the area of reporting and managing profits.